Hey, welcome to this Invest 1000 case study. This is episode 1 of 2. We're going through a coaching call and we go through some thoughts and process of how to approach this whole case study. So this is featuring Lester, and let's get right into it. For the people that are going to be viewing this video, here's the disclaimer. So I'm just going to leave this screen up here for another few seconds. So if you want to read the whole thing, you can pause it. Okay, so what we're going to cover in episode 1 of Invest 1000 is just a general overview. You've already gone through like just tutorials and stuff, so it may be redundant in some cases. So like I said, feel free to butt in anytime. Want to make it interactive. So it's the overview is going to consist of just a quick rundown of how the action score works, how I personally do things, how I read it, how I interpret it, how I figure out, okay, whether I should be looking at something or not. And then some other tidbits like rules of thumbs, like, okay, how do you quickly avoid value traps? And then what the majority of the episode 2 is going to consist of is once you've created the stock shortlist, we're going to go through that. We're going to go through like the valuations and some fundamental quality checks and stuff like that. And lastly, today we're going to go through just some ideas about buying and selling. Now, there's no hard and fast rule with all these buy and sell rules. And then we'll go through some best practices for allocation strategies. There's a whole mix. And you've mentioned that you're going to do technical analysis. So we'll definitely want to get your thoughts and hear about how you want to get, how you're going to implement that.
Yeah, for sure.
Quickly, how the action score works is it's based on 3 principles: quality, value, and growth. One of the things that I had issues with, and when I look back at my previous stock picks, my big winners came from when I was taking a holistic view of the stock, when I was looking at the quality, value, and growth. Where my losers came from was like when I was only focusing on one specific areas, mainly the value side. Like when I was just looking for cheap stocks, and at that time I wasn't like buying 20 or 30 stocks. I was holding about 5 to 10, so I was like really concentrated, looking purely for value, and so I ended up getting a lot of value traps.
You weren't getting any huge returns? Usually when people are concentrated, it usually goes one way or the other, right?
Exactly. Exactly. And that's a good point because like I read on the news, like there was a fund manager who opened up a Tiger Cub fund. You know, she was having like crazy superb returns, and this was in the good years, but then once she hit a bad year, it was like it completely devastated her. And I mean, if you're doing it like Buffett, then that's great, but he focuses on all 3 aspects actually, like quality, value, and growth. Like people don't seem to appreciate that. Like we just get into the mindset that, oh yeah, he's a value guy. But when Buffett invests, you know, he goes through all 3. It's just that he doesn't. I mean, he just makes it into such an easy process for him that it makes it look too easy. And so with the action score, what I try to do is I've divided. These are the core metrics that we use. You've seen George's paper, and he ran through all these different simulations. The criteria that we go for is that the Piotrowski has a big impact. I'm just leveraging other people's research that's already been done. So it's already proven. So we use that as a junk filter. The second part is the CROIC. Just love the way it's an under the radar metric, so just love the way it's able to determine quality of a company, and the rest, which I'll go on in the next slides. So with the quality score factors, you know, these 3 are the main areas of how the action score in the quality section is done. So it looks for CROIC, free cash flow divided by sales. Free cash flow divided by sales is a great metric because it just shows you how much free cash the company is able to generate from every $1 of sale. When I like to look at stocks, I always like to look at free cash flow to sales of companies where it's above 10%, so that if they make $1 in sales, then 10%, like 10 cents, is actually free cash. And that's like, that's a huge money generating company.
Oh, okay, cool.
So the next set of factors is the value score factor. I've tried to keep it as simple as possible. What I found in while I was working with the action score like throughout the like a whole year was that the more you have, the more it condenses the universe to the point where there's nothing that meets it. And if a certain stock does happen to meet all those criterias, it didn't really work out that well because it was just so confined. And so I've limited it to the pure trust to act as a junk filter, and then price to free cash flow, EV to EBIT, and price to book.
Oh, okay. It's kind of cool because I guess for anyone that does like robot trading, algorithmic trading, or whatever, it's like if you run your robot to like learn from this data set, if you spend too much time on it, it actually is a terrible model because it's only fit for that particular data set in time.
Right,
So
right.
I guess that's kind of what you're getting right here.
Yeah, because I mean, we have no idea how things are going to happen, and who knows, maybe like 5-10 years down the road, somebody like quant funds will see this and then they'll start doing the same thing and crowd out the strategy. But in any case, you have no idea like what the economy is going to do, right? So there could be good years, bad years, and then like you said, if it's constrained to just such a tight variable list, then it's not going to perform well across a broad economy, across a broad long term. So one of the factors that I really wanted to focus on was creating long-term wealth and creating an action score that will be easy to use over a long term, as opposed to just constantly having to churn through strategies every single year to try and stay ahead of somebody else.
Yeah, it makes a lot of sense.
Yeah, so the last one is the growth factor. So one thing that this is a sort of a confusing one, because when people say growth, they talk about EPS growth, like growth in revenue, whereas the growth aspect that I use is very different. I've got growth in sales, but the majority of the core driving factor of the growth score is this GPA, so gross profit to assets. And there's a paper that I linked to in and that I'll provide. But basically, it shows you how profitable the company is, and I'm checking for whether that profitability is growing. So it's actually a growth in profitability as opposed to just a standard random growth in sales or EPS, which is very noisy itself. When we go to choose the stocks, you want to choose the higher grade stocks. And I bring up my fishing example. Like last year in Seattle was a couple of years was the first time I actually went fishing in Seattle. Like I used to grow up and then in Australia, we used to go fishing on the shore. There will be so much fish out in the ocean. It will be such a nice day. But then I come to Seattle and it's all freshwater, it's all lakes, and I've never done lake fishing. So I had the wrong gear, I had the wrong bait, I didn't know what depth I was supposed to do, and I had no idea how to do lake fishing. So I spent the whole summer catching absolutely zero. And it got to the point where I go to the lake and somebody felt sorry for me. So he threw me one of his trout. So that was my fishing endeavor. And then that's exactly like what it's like in the stock market, right? The stock market itself is a massive expansion of water, you can say. And then each stock can be considered a fish. So some people, they're just fishing everywhere randomly, trying to hit the jackpot and catch that one big fish. Whereas with the action score, the whole goal is to fish in the parts of the water where there's fish, where they're swimming around, whether it's a small one or big one. The goal is to catch as many of those fish as possible in that secret hidden fishing spot. And so that's what this covers. One thing, and with any strategy, it's like you have to understand, and I want to put out there for everybody listening, is there is no such thing as a perfect strategy. Some people, they signed up for Old School Value, they tried it for like 1 month and then they quit. And the reason was that, hey, they didn't make money in 1 month. And I'm like, okay, that person wasn't the right fit. So with any strategy, whether it be 1 year or like a few months, the expectation is that it's not going to be 100% jackpot, a lottery. There's going to be definitely a probability that you will lose money. And it's just, we reduce that risk with the allocation strategy that we'll talk about towards the end.
Isn't it kind of good that they quit in a month? Because think about it, like those type of people that are like short-term oriented, they probably would have leveraged their position really hard the next month and probably lost a lot of money.
Maybe, they could have done something. I have no idea. Like, I didn't get enough feedback, but you never know. There's like all sorts of people. So it's just the mentality and the mindset that is one of the most important with following a quant strategy. Like over my whole time of investing, I only started doing quant strategy a couple of years back because it was just so difficult for me to get over the hurdle of just trusting in the process. Now, I with my portfolio, because I'm not just running like a simple like $1,000 portfolio or test, I have a section where I've still got my core holdings from like way back. For example, like I hold U-Haul, I hold Apple, and these were from like 5-6 years ago. So those I haven't sold out. But for the newer positions, I've definitely been training myself and learning myself to trust the process. And one of the worst things is like meddling around with it too much. I still do that because I just can't get over the fact that I just want to have some control and feel like I'm in control. I'm a control freak.
It's human nature, man.
Yeah. But as I keep transitioning myself and training myself, into getting into both worlds, it's just being able to trust the process. We're going into the how to read the action score. It's pretty simple, but there's some little nuances here and there. As I said, you want to focus on the high action scores because this chart pretty much tells you the whole story. What I found is that when you focus on like the F grade stocks, there's so much noise in there that there are some high returns. Like for example, if I like these gray points refer to like the returns of some stocks, and you can see how there's some huge returns, but at the same time when you average out everything, it's such a hit and miss because you could easily go for one of these negative stocks as well. Whereas on the highest, as you get closer to the high end, the average return or the average losses get lower and lower. The top end, like maybe sort of like pretty much flatline, but you're also reducing the risk. And so that's a lot of where I want to emphasize. I put a lot of emphasis in trying to reduce downside risk, because if this involves holding for 1 year, at the end of the 1 year, there's still a turnover. Like if you have to rebalance, and let's say the action score tells you that, okay, here's a brand new set of 20 stocks. That's a complete 100% turnover. And so you want to reduce the risk. You want to try and reduce taxes as much as possible. You don't want to sell too early in the year and have to pay taxes. So,
right.
So that's what this chart will hopefully show.
Yeah, that chart made me want to sign up for old school value because I wanted to be picking the A grade stocks. Think about it. The worst case scenario is you make money or you make more money. Wow, F grade, it's like I don't want to see like an 80% drawdown. That'd be, everyone gets really mad over 50 already. So.
Well, you're an optimistic guy, so I'll just show you this screen again and say, hey, there's a probability return of less than 0. So. If everything is in the A grade, then I call it the trifecta. It's just a simple name that I gave. Now, it doesn't mean that every trifecta stock is going to be a slam dunk, because an A grade could easily turn into a B, C, and D. Because an A grade stocks basically either stays where it is, or the only way the direction is down. It can't go up any higher than an A grade other than like the stock price, because even if an A grade starts like really appreciating in price, then eventually like the value score is going to go down, right? So that will transition it from an A to a B. And so because of that, sometimes the trifecta stocks is a good area to look, but it doesn't necessarily mean that it's the perfect stock to invest in. Okay, so the trifecta also means that you're getting right in the middle of everything. You're like, it's quality, value, and growth. I like to, again, with this chart again, I like to hang around the A's and the B's. And with the B's, there's 3 different variations that you can do. Like when you just look at the overall score, like the action score, this is what it looks like. But when you actually dig into how each factor is done, you're going to come across 3 potential variables or 3 potential scenarios. You're going to have whether it's Q and a V, which I call a sleeper stock. a manja stock where it's just quality plus growth, and the GARP stock where it's like value plus growth. And I call this the GARP growth at a reasonable price, sort of like naming it after Peter Lynch because he liked value stocks and he liked growth. And and then he'll probably rank quality as the number 3.
Mm-hmm.
Same with Munger, he ranks quality and growth, and then he'll be, he's willing to overpay on some stocks if it's like really high growth and really high quality. So that's the 3 areas that I like to look at. Personally, when I've looked at my portfolio, a lot of the time it's I'm finding a lot of stocks in the Munger style stocks, the Munger stocks, as well as like the quality, the sleeper value stocks. I haven't found too many that are in the GARP stocks category. But so when you create the shortlist, since you're likely going to be hovering around the A's and the B's, like if I show you in the screener, like this is my account, there's some that you won't have, but you can look up in the screener the categorizations that's already done for you. So look up these, and then this way it's just an easier way to shortlist it.
Mm-hmm.
I'll go through later on how like the different ways of going through and sorting out what stocks you want to create your shortlist.
Intuitively, why do you think that you don't have a lot of GARP stocks?
I don't really know. Maybe it's just because that it's pretty hard to find a value stock with a big growth prospect or with good growth ideas or growth metrics, because by the time a company has like a really good growth score, a lot of them have already run up in price.
Mm-hmm.
And so it's either going to be like a quality stock, a Munger stock where the growth score is going to be good and the quality score is going to be good, but it may be a little bit overpriced. It's just the combination of trying to find value and growth at the same time. It's not as easy as trying to find, say, quality and value.
Oh, I'm kind of curious if George could do a back test for all these 3 different kinds and see what happens.
Maybe. So with the C and the D, I won't get into too much, but these are the type of stocks that you actually, I subconsciously was looking for. So I was looking for companies where either it was just a really skewed on the value side, or maybe I'll look for something like really high quality, or I wasn't really looking at darlings or growth stocks itself. Like these would be something like the Teslas or LinkedIn back then before it was bought out and stuff like that. So, I found that looking back, like just going over my past purchases many years back, that most of them tended to fall in the value trap area where I was just focused on value. With the F-grade stocks, now this is the ones where I don't even bother looking because it's just too hard to find quality stocks and try to cut through the mess. In the D's and the F's, there are some good stocks, and if you're inclined, you can go through them. A lot of them contain like financials, OTC, miners, utilities, just really capital intensive companies like that, which fails a lot of like check marks, even if you're trying to do it manually yourself. So that's where I tell you to, tread carefully for new people into the system, or even in general, it's all about getting back to that fishing analogy. Yeah, you could fish the ocean. Like you could go fish in like really rocky areas and really go for those unique fish. You catch a lot of big fish as well. Or you could just make it easy on yourself and go to a spot where that's just crawling around with other types of fish that are much easier to catch and have dinner. So the red flag areas that I personally, and this is just my my list of industries and sectors that I stay away from. So cyclicals, this whole list comes down to here.
I see a red flag for corporate action. So if you had like an A grade stock and it might go through a merger, do you not pull the trigger on that one and wait until it's over, or what?
Yeah, so if it's going through a merger, then you've probably missed out already. Like there were some A-grade stocks that have gone through or getting bought out already this year. But then once a company gets news, like for example, like Whole Foods, fresh in my mind, goes gets the merger announcement, the stock is it's going to hit that buyout close to that buyout price anyways. And so by the time you if you buy it after the fact, then you're probably at best going to get like a 1% return based on how much that arbitrage is going to be, how much that difference is going to be between the current trading price and the final buyout price. And what I mean by corporate actions is there was a company, I forgot the name, but it did so many things. Like it split, then it also went through mergers, or not mergers, it bought out different companies. It also changed its ticker. And so all of this messes things up.
Okay, cool.
Here's two examples. There's an A grade and a B grade. One is GameStop, one is Facebook. So which is better? GameStop, you look at the chart and it actually looks like, okay, yeah, this is about where the fair value is. And the intrinsic value target is and the sell price. But the stock price is currently trading at somewhere around here. So there's a big gap between here and here. The action score, however, shows an A, and then when you look at like the breakdown, it actually looks pretty good. Compare that to say a B grade stock, Facebook, where it's got a B grade. It's on the selling price of the valuation side, so it's not undervalued. It's probably fairly valued based on what the chart shows. And the value score isn't that great, and it's a B. But really, at this point, if you had to choose it, like if you created a short list of 40 stocks, and then GameStop and Facebook happen to be on that list, which one do you choose to buy?
I would say if I just read through the OSB stuff and wasn't so detail oriented, I would just close my eyes and pick the A. But looking at it from the B side, if I was like came from a casual background, I'd be like, come on, man, Facebook, can't get enough of that Zynga poker.
Yeah, and I mean that's pretty spot on, right? Because what the algorithm and what computers can't really detect is like GameStop's going through some really difficult challenges with their current business model. That's something to really think about. If you either had to choose between GameStop and Facebook, like you could only choose one of these two. The better bet would be to choose Facebook because on the qualitative side, you've got the growth prospects, the growth aspects, all the different areas that it's trying to expand into. Whereas GameStop, they've like hit a hurdle and it's pretty evident that they're going to struggle for the short term.
Right. On a technical standpoint, you just go with Facebook because look at that. The trend's your friend, man, and it's going up. Two
different ones. Another A and a B. One is Gilead Sciences. The second one is Nu Skin. And these are both controversial picks because Gilead has been underperforming for the past several years. One of the things that still have to take into consideration is that the whole idea of the action score is to have a 1 year holding period. If I was just putting this in my value portfolio and then based on all the other research and stuff like that, I would probably hold Gilead want to hold it much longer than 1 year. That's probably why I'd buy it. Whereas if you bought it and then you only could hold it for 1 year, you still have to think about, okay, how you think it will perform in 1 year. Compared to Nu Skin, this is also another controversial stock pick. I mean, people were saying it's a pyramid scheme. So one quick acid test that I do is I try to get a market sentiment of what people say about these controversial picks. So if I have my short list and then I have something like Gilead and Nu Skin, what I would do is I'll go to like say Seeking Alpha because it has a lot of opinions. Just go through like the articles and try to check out what that sentiment is. I'm not trying to see what people are saying about the company because at the end of the day, they're just opinions. And on Seeking Alpha, you have to be careful about who you read and what you follow. So if some people are saying, hey, Nu Skin is going to go down the toilet, it's doing this, blah, 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 don't let that scare you off. Again, we're looking at the numbers and based on what it's actually reporting, that's what we're going after. And so on a controversial pick, this is a tough one. If I had to choose one of the two, I would still go with the A grade here.
I'm real happy you did Gilead because I was actually considering adding that one before before we started this call.
Okay. Okay, good. Okay, so that's probably an example that we can go through later as well.
Okay.
Yeah. And I mean, when I was creating my portfolio, like I hold Nu Skin, I didn't like the business model, but I didn't want the bias to hold me back. So one of the rules of thumb that I jotted down towards the end is don't buy something where you hold more than 2 or 3 in the same industry. That's just something to factor in as well, and that's how to limit your losses and protect your downside by not over allocating towards so many in a certain sector. When you create your stock shortlist, you've mentioned Gilead, so keep these factors in mind. So consider the minimum number of stocks you want to hold. So have you thought about, you mentioned to me before the call that you purchased 4 stocks because you didn't go through like all the other stuff that I mentioned.
Yeah.
But now that you know that, I highly recommend having at least 20 stocks. That's the minimum, but is there a minimum or a maximum that you're thinking about?
I'm thinking of going for the 20 only because of the fact that I only have $1,000 for this project, so some stocks are gonna limit me based on their share price, and that's really the real reason why I'm going for 20. Because if I went for 30, I'm gonna be stuck with maybe stocks that are like $20 or less, and that's gonna even lower my chances of picking A grade stocks.
When I created mine, I noticed that when I was going through the A's and the B's, a lot of them were either in the $50 range to like the 50 to 100. Most of them were between 50 to 80.
Mm-hmm.
And so that's definitely something you want to think about too. And how are you going to be, like, which broker are you going to use? Like, how do you plan to trade? Like, are you going to be like using a basket where you just, I think Fidelity offers something like that. Like a motif or something?
Right. I thought about this way in advance on doing stocks. So the fact that since I'll be only going long only, and obviously $1,000 isn't a lot, so I don't want to get eaten by commissions, I actually went with Robinhood brokerage because it's commission free. But the minus thing is it's all on your phone, so if you're not into that's kind of bad for you. And the second part is they don't really allow day trading. They also have that pattern day trading rule for one single stock, so it's perfect for OSV because it's value investing, and your holding period's going to be roughly around a year or more, hopefully.
I use Interactive Brokers, so the commissions are still very low. Like you can get it for like less than $1 per trade, but still for like a $1,000 portfolio, it's good that you've got that in control.
Oh yeah, I was gonna go for Interactive Brokers when I put in a larger account size.
In the like, what I mean by define the universe is like in the study I did the entire universe where it goes includes all the sectors, utilities, financials, gold, miners, OTC and everything. And then I created that filtered universe, right? So do you have a specific list of sectors that you're going to exclude? Is that something that you've already thought about ahead of time? Or because this is something that you can completely do as you create the shortlist, of course.
Right. For the universe, I was pretty much going to go with NASDAQ stocks and ones listed on the New York Stock Exchange. I was looking at... I didn't really know anything about stocks before a week ago, and I was looking at the OTCs, and the price action looked kind of choppy. So I'm assuming that OTC stocks actually have low volume. Do they? I don't know.
Yeah, pretty much. Well, it's definitely going to be much less than just regular stocks on the Nasdaq and the New York Stock Exchange. So and because the volume is less, you have to be either patient. I don't know whether Robinhood allows you to trade OTC stocks though.
Yeah, I didn't check, to be honest, because I already filtered for it.
I didn't rule out OTC because I have always found success in smaller cap companies. It's just less followed. There's less volume. Once a company starts moving up in price, and illiquid stocks becomes very liquid. And so I don't limit myself to removing OTC. I've actually found there's a lot of good companies there. But based on what you do, this is something where it's completely up to you on creating the shortlist. So go ahead, just make sure that you can trade it on Robinhood.
Yeah, it's tradable. So I guess that's my question then. Obviously, since I only have $1,000, I'm not going to have that many shares. So do you think I'll run into any illiquidity issues?
That, how about I'll leave that up to you because I don't know.
Oh, okay.
And then you could probably provide your thoughts, and then I'm sure people will be interested who are either getting into investing or trying to just see what type of stocks have some liquidity or not.
Yeah, cool.
Okay, yeah. So just jot down your thoughts, and then we'll share that with the readers and the followers.
All right.
So when you generate the stock shortlist, there's 3 ways you can do it. You can go into your account, so go into download area, menu, download area, and then towards the bottom, click this. This is updated on a daily basis, and then it's all nicely formatted. So this is, you can quickly see and use this as the shortlist. So you can, it's either just use it like your spreadsheet screener, just create like a filter, and then sort of manually filter which ones you want. The second,
Oh, I used to be an Excel ninja. You could do a Control A
right?
and then hit Control T, and it makes a nice little table.
Yeah. Okay. There you go. Okay. So So if you're fully aware of Excel, even better. Let's see. The other way is you can actually export the database yourself. So I don't know whether you've seen it that much, but go to stock database. It's going to be the same thing, but it's just going to be click this export button, and then it's going to export in CSV. So it's going to be a much more raw format. And if there's a particular, you can go ahead and create like the different types of reports. So if you don't like the data that is being showed in this spreadsheet, then just customize whatever you want in the reports. Like create your own estimates or whatever, customize it to you, and then export it, and then it would export based on that. So that will be more highly customized to you. The third one is obviously, again, you can do it based on the screener. Just either, if you have an idea of what you want, just set up different types of screens. Like if you just want to look at, like, say, free cash flow and growth as the main criteria, then you can use that. Export it again. And then you can create your shortlist like that. So we've covered this, but yeah, consider volume. You don't want something where, because you are using $1,000, you don't want something where it's going to be where you have to buy one share of like a $50 company and the trading volume is low, because I doubt somebody's going to want to be selling you one share.
Oh yeah. Oh, that'd be terrible.
So rules of thumb. So again, these are just rules of thumb based on what I have experienced. For anyone listening and watching, just take these as a general guide and then custom and make it your own. It doesn't mean just because I've done this and based on my experience that this is going to be the exact same for you. Some people have much higher tolerance for stock prices. Some people don't want to tolerate daily stock price fluctuations. So just take it with a grain of salt. Spread your bets. So you're going to be doing 20 stocks, so that's a good start. And although it would be nice to have equal weighted positions, it could be tough. Like if something is like, say, for example, like U-Haul or some expensive stock, like let's say even Berkshire came on your list, then you wouldn't be able to buy Berkshire, right?
We'll make it happen.
Unless you can buy like partial shares from somehow.
No, we can't. So I'll just skip out of my universe. Basically, if it comes over my 20 stock price limit, if I divide it equally, I'm not even going to consider it.
So hopefully that's not going to affect the performance. We don't know. So I mean, again, this is a really, really good case study because it's going to tackle a lot of different scenarios that a lot of people may be curious about, and also we'll go over things that some people may not have an issue with, but then it will see how the actions go and how just in general the whole strategy works.
Yeah, definitely.
Yeah, don't chase stocks. Like the reason why I asked you to do like aim for at least like 2 times the minute, so at least 40, create a short list of 40 stocks, is that if you see something and then you try to buy something and you're waiting, you don't want to chase it. If it's a growth stock and people have suddenly gotten into the stock and it's just going up, you'll have to walk away. You don't want to chase it. This is the one that I've recently incorporated, maximum 2 to 3 companies. Like earlier this year, there's been just so many retail companies falling left and right. And so these companies previously, they weren't that cheap, but then they've fallen into like the value realm. And because they've had pretty good historical numbers, a lot of them actually came into the A score, action score A grade. And at the beginning of the year, I saw about at one time in a list of 20, there were like 8 to 10 retail companies. And that's where I realized, okay, there has to be a limit, because otherwise 50% of my portfolio would be in retail companies, which are very cyclical, which are very potentially dangerous, because a lot of retail companies do go bankrupt. And especially the fashion ones, I really dislike fashion retail companies. So the ones that I hold in my portfolio, they centered around discount stores, say like TJX, or some more specialty companies that aren't really followed by company or by funds and institutions.
All right, so I guess I shouldn't pick any four of the same industry then when I look at the screener, I guess, right?
Yes.
Okay, sounds great.
Yeah. So just diversify like that, limit your losses, because it's a quant strategy. The truth is we're not doing a lot of qualitative data. One of the things that Monish Prabha, actually, he gave a talk recently at Google, is talking about, the more you do work on a company, unless you have such a strong understanding of your own behavior, most people are going to tend to buy it just because of the bias, because of all the time they've spent. And so because of that, we're trying to stay away from over allocating to certain companies, to certain sectors. Because at the end of the day, it all comes back to this. This is where you want to be. This is where you want to be. And because the average return, because we want to see it going up. At the end of the day, everybody invests to build wealth, to make a profit. Nobody invests to lose money. And I think this case study is going to be the same. We'll see. 1 year is going to be very short, and it's going to be a test of just behavior, really, and just how you follow the process. So for people that follow along, it's going. I mean, just to, let's say, protect my behind, it's going to be a lesson in the process, rather than just see how much money is made off this $1,000.
Yeah, so I'm expecting, worst case scenario, maybe a 50% drawdown, but let's hope for the best, and maybe we'll just start our own fund after this one.
I really hope it's not going to be a 50% drawdown.
Yeah.
Okay. So with the buying and selling, simple rules. You mentioned this over email, but like, if for people who ask, like, okay, what should I do if it drops? One of the things I do is, it's still a 1 year holding. So in my personal portfolio, I just hold for the 1 year. If something drops from an A to an F, which it could, one example is Cal-Maine. I still consider it to be a pretty good long-term value holding, but because it dropped in the value score, I ended up selling after 1 year. But for something like that, I didn't sell beforehand. But you're going to be using technical indicators, right? So walk us through that. Right. Like, how are you going to be incorporating that to do like an entry position or an exit?
Yeah, so for an exit position, I'm gonna mostly use the daily charts or higher. So daily, monthly, weekly, and I'm gonna see that based on the indicators that I'm going to pick, which is trend lines for support and resistance and Bollinger Bands. I just picked those because I find them to be really easy, and I'll be happy to walk through a couple of how I'm going to use them later down the line. Basically, if I see the price moving in a bad way that I don't like, I'm going to exit out probably a year earlier. And the plan with that is, if you guys remember from George's paper, where in the middle of 2015, his portfolio went up and then it lost like 40% returns.
Right.
I'm going to see if I can mitigate some of those losses, so we can put more money in our pockets and maybe, buy a McDonald's or Panera with our extra money or something.
Well, definitely want to get you to jot down like your thoughts and stuff as you put it into practice. And then if there's a particular trade or something where you feel like like my personal thing is to just hold it and then just let it go. But then as you do it, this is in your control. So if you feel like there's something where, okay, this is going to really hit the floor, then, and you need to sell out before it goes down further, then please, share your thoughts, jot down, and then it'll be interesting to see how it goes.
Yeah, for sure.
Okay. Lastly, just want to end with, this is a quote from Joel Greenblatt. So it comes from the little book that still beats the market. So again, there's nothing wrong with picking stocks based on a quant strategy, because all the work is based on the process, has been put into the process. Just because you spend like 20, 30 hours into a stock, it doesn't mean that it's a great investment. So Lester, here's your mission. So your mission for episode 2 is to get your first shortlist of the stocks. So follow the guidelines. I'll share this video with you if you need to go through it. But for the most part, I think you've got a pretty good handle on it. You've already gone through the tutorials beforehand. So make sure, since you're going for 20, create a list of at least 40, because you're not going to be able to buy everything. Jot down so that we can share the criteria that you use.
Okay.
And then based on your first purchases, would like to definitely get your thoughts as you go through your shortlist and stuff, like how you feel like you did with the first 4 purchases that you did. That concludes Invest 1000 episode 1. In the next episode, we'll go through what transpired after the call, what type of stocks Lester ended up shortlisting and purchasing, and we will reveal those stocks in episode 2. So see you in the next one.